The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. This is Jennifer Schaus coming to you live from Washington, D.C., and we are continuing with our government contracting webinar series, Learn Before You Leap. Hopefully everybody can now see the screen. And so we've covered various topics in government contracting, ranging from grants to some sales strategies to the mentor-protege program. And today we are lucky enough to have John Fedowa with us from Armed Corps, and he will discuss access to capital. The webinar is being recorded, and so tomorrow we'll have the link to the recording on here as we wrap up Thursday the 21st with winning proposals. So if you needed to get to any of the recordings after today or tomorrow, you can also find those on our website, and we have a section where we list all of the webinars and the recordings. So as mentioned, John Fedowa is sharing his expertise and knowledge on access to capital, specifically for the government contracting sector. And just a brief note about my organization. We're a Washington, D.C.-based firm. I've got over 20 years of government contracting experience, and we primarily help companies with the GSA schedule services. So we help companies get onto the schedule, make modifications, assist with the audits, and renewals. We also host many government contractor events, whether they're networking or workshops, and most of those are held at the Kennedy Center here in Washington, D.C. Additionally, through many of our partners, we provide support services for government contractors, ranging from federal sales to market analysis to 8A certification. Our website and contact information is listed below. We do want to give a shout out to our sponsor, Uninet. They're a Virginia-based software firm helping government contractors with their back office focused on financials. So making sure that your systems are DCAA compliant, that you can track billing and revenue, and then plan and some resource forecasting as well. Uninet's website is listed below, and the best contact there is Morgan Franklin. Her email address is mfranklin@uninet.com. I believe that they offer demos and trials. So today's agenda, we'll give a little bit of background and information on John. He'll run through his presentation. We'll take some questions from the audience, and then John will wrap up with conclusions, and then the recording will be available for download later this evening. So a little bit about John Fedowa. His company is Armed Corps. Their website is armedcorps.com. He's been in factoring government contracting finance since 1999. He's also been a principal in a government contracting firm here in the local area, and he's got a lot of expertise related to the FAR, which is the Federal Acquisition Regulation, as well as DFARS clauses, which specifically relates to Department of Defense. For those that don't know, the FAR and DFAR is pretty much the government Bible. The reading there will probably put you to sleep, but it is somewhat complex, so John brings that unique perspective and experience to his business. Okay, so what we'll do now is pass the microphone over to John, let him run through his presentation, and if you have questions throughout, on the right-hand side of your screen, you'll see a gray box. You can type your questions in. We'll answer those in the order that they are received. And John, the floor is all yours, and thanks again for sharing your time with us today.
Thank you, Jennifer. It's a pleasure to be here, and I welcome this opportunity to reach out to all the people that that you connect with in all your various events and your lists. And this is a very useful forum, I think, for a lot of people, hopefully. So in this first slide, as it says, these are perhaps some cliches and analogies, but they hopefully will help people look at this this a little bit different. And so as I listed here, rather than just thinking or coming to the conclusion based on what you perceive as a shortfall in your capital, your working capital, and concluding that that's what you need, I think that there's some things people should do prior to that. First, you really need to conserve your operations, optimize them, That's the most efficient thing you can do. Rather than just assuming that you're already an efficient operation, you should really look for ways to minimize the requirement that you need for any sort of outside capital. To do that, you really do need to know what you need, and also what you may, if you come to the conclusion that you absolutely have optimized everything and you do in fact need capital, then you really need to look and see what it is that your company can offer a financial institution. One of the #1 types of calls that we get is someone who's already received an award and they need to start up like next week, and this is the first time they've really given it consideration as to how they're going to fund their operations, fulfill their contract, et cetera, et cetera. And at that point, they think that just having an award is enough. And let me tell you, it is something, but it's not enough. So you really need to understand what you have to offer a financial institution. You need to do your homework. You need to find out what various things, and I'll run through some of these later in the presentation. You need to find out what things might be available to help you. And you also do really need to do some research, shop around. So along those lines, again, getting back to a typical phone call that we receive, people think that because they have an award and a contract, they can get money for this. They can get some financial institution, be it a bank or a factoring company or a purchase order finance company or a private investor, to give them money and allow them to handle it. And that's not the way it works, let me tell you. You need to you really do, there is a process, and people are going to do due diligence on your company, and you should be prepared for it. Another sort of in the myth category is mobilization funding. A lot of, especially new contractors, think that this is something easy to get. It's not. It's very difficult. It is out there in some very limited circumstances for certain situations, but it is not at all something that you should rely upon, and the odds are against you getting it. I just want to be clear on that. So what you should do is, instead of relying on these things that you may have heard from another contractor, you really do need to build your track record, make sure that you don't have anything in the way of your Dun & Bradstreet report or any sort of credit report that will make it very difficult for you to get funding at all, let alone quickly, because these are very slow things to fix if they have problems on them. Okay. There we go. So again, getting back to the beginning here, the less you are going to need, the less you're going to have to borrow or factor or give away in terms of equity in your company. Ways of optimizing are one of the easiest things to do to reduce your cash flow problems is to make sure that your contract is set up in the best possible way. A lot of people, especially new contractors, are afraid to broach this topic with their contracting officer, but they really shouldn't be worried about that. They should try to get the most appropriate billing and payment schedule possible from the contracting officer, either before the award or directly after the award. And there's no way that you should have a situation where you're going to be incurring lots of costs from your suppliers for weeks or months prior to the point where you can issue your first invoice to the government and have it accepted and paid either net 15 or net 30 or slower afterward. So definitely try to tweak your payment schedule on your contract so it minimizes the need. And also tying into this is billing and collections. So even if you have a good payment schedule in the contract, you should make sure to know what sort of delays you might expect with this particular, whatever agency it is that the contract is with. Every single agency has different requirements and different quirks, and you should know them and make sure that you'll be able to present at the earliest possible time an invoice which will be quickly accepted and paid in the minimum amount of time. So again, these are all ways of optimizing, and we can help with that as well as a lot of other companies out there who are experienced. Okay, so the first of the several types of ways of solving this is financing. This is what most people call all of the ways of getting working capital. A lot of people generically call it financing. In reality, financing is a specific thing. Pardon me. So true financing is pre-performance. And what I mean by that is that it is a loan, and it is the riskiest to the financial institution. It's the riskiest way to provide capital to a contractor. There is no guarantee if they are giving you money, if they're loaning you money, there's no guarantee that you actually will finish your work if it hasn't been finished already. And so that's why financing is the hardest to get. It's because it's pre-performance, and since nobody knows the future, even if it's a good bet, it's not a sure thing. Also, in financing, because of the risk of the pre-performance type of working capital loan, they're going to look at other collateral usually. So they look at liquidation value. In other words, they don't care if potentially, they don't want to get in there and run your company and maximize the opportunity or the contract the way that you might think of it. What they look at is how they can, if the loan to you, to your company doesn't work out, how they can liquidate your assets. Usually this is property, sometimes it's some other type of reserves. So because it's coming from banks and certain other financial institutions are the ones that will do financing usually. It's least expensive because of the second bullet there with the collateral aspect. So they have it's risky, and then they also have collateral, and so it's least expensive, but it also has the toughest requirement, and almost universally will require a personal guarantee and comprehensive liens. So if you can get it, it is the cheapest way to go, but it is hard. And so for a new contractor or a contractor in a seasonal type of an industry, even within government contracts, or a company that's experiencing rapid growth, it may be very hard to get financing. Factoring is another form of another way of providing working capital, of course, and that's what my company specializes in, amongst a few other things. And the essential difference between the difference from which everything else flows with factoring versus financing is that it is post-performance. So no factoring occurs until the item has been delivered or the service performed, and generally that no one disputes that that's happened. So not only would it need to be a fact, but it would need to be an undisputed fact. And so at that point, the reason they literally call it factoring is because it's taking a percentage rather than adding a percentage to a loan in the form of interest. Factoring takes the face value. Factoring takes the face value of an invoice and discounts it and treats it as an asset. This is something that actually goes back to Roman times, and it's been very popular in Europe for the last 50 years or so, since World War II. And it's something that, while it is the most expensive of these two options that we've discussed so far, it really doesn't have much risk involved in it, and so therefore it has the easiest terms. So it is very convenient for certain industries, for new companies, for startups, and that's the reason that factoring is sometimes the best solution. The other thing you should do, if you're going to go out there and do your homework and research this, a lot of times factoring companies will quote their rate in the form of a net 30 rate. So if the contract terms are 30 days from acceptance, then the factoring company will quote you a certain discount rate. It's not enough to just compare those rates. You should also compare terms, and you should also, in other words, guarantee requirements and such. But you should also calculate yield. So if one company, if they're all basing it off of a net 30 rate, but one of them is only giving you a much smaller advance, then that's actually not going to be as good of a deal. So yield would be the face value of the invoice less the discount and less the reserve, and so you can compare different rates based on the cost that it requires you, the cost of that yield. So I'll explain that further later, but basically you really need to make sure that you're comparing apples and apples. And again, the reason for choosing factoring would be if you're a new company, or you have a seasonal business, or you have some other complications which would scare away a bank or something. It's something that can even be used with financing, by the way. So, all right, so let's move on then to the next one. Asset-based lending is really a hybrid of these two that we've just described. It incorporates some of the aspects of financing. The rate, the cost of capital tends to be somewhere in between factoring and financing, but in a lot of cases, almost in all cases, it will be very focused on your accounts receivable, not so much on your collateral, your property or personal guarantees and such, although it can be. There's a whole universe of different terms and conditions out there, but it is a hybrid. That's the best way to remember it. And it does, because of the fact that it's a hybrid, it does tend to be complicated because it requires a lot of the same things that financing does, in addition to the requirements that a factoring company will require. But it tends to be a little bit more flexible than factoring, and it's cheaper. So, again, it's something to look at, and if you can qualify for it, then you should strongly consider that. Purchase order financing is something that a lot of people misunderstand, and they think that once you receive a purchase order from the government, which is essentially just a small contract, a contract $25,000 or less, or $50,000 or less usually, and that someone will provide you a way to fund that. That's really not what it is. What it is if you get a large order from the government and you want to get a loan to specifically finance the production of something. It's usually products and items, so real goods, or it's not usually services. So it's something that is very useful in some certain circumstances, but it does require, again, that the lender be able to, in the worst possible case, be able to liquidate whatever it is that you are that they're loaning you money to ship. So if you have 10,000 laser printers that you're supplying to the government, that's something you could probably get purchase order financing for. If you are producing custom items where the only possible customer for that custom item is the government, then that's not going to be a good thing, because there's no way they can just sell these unique items on the open market. And what they'll do, especially in the latter case of something being a little bit less of a commodity, they're really going to examine the track record of the company providing the service, and so in this case, the contractor. The other thing is that almost universally, the purchase order financing company will require that they are taken out. The term is that they're taken out by a factoring company. So at the point where you're able to get factoring, the purchase order financing company wants to receive that factoring money directly from the factoring company. So that means that it's going to be a pretty expensive option, because you're going to have all the costs associated with factoring, and you're going to have the purchase order financing costs as well. And those typically, not always, but typically run about 2 times that of factoring. So it is a pretty expensive option, and you better have a lot of margin in your contract to be able to do it. Next slide.
Should be on the slide, other options.
Okay, I'm not seeing that on here, but yes, so there are other options that you can do which don't involve specifically the contract at hand. One would be to get an investor. So if you got a really exciting, creative company that you think that you could convince some investors to take a stake in, then that's another way to go. That's not really an option for a lot of companies, but if you do have a company with a good upside potential, and you're willing to deal with outside investors, especially if they're only interested in the return, then this is something you should consider. So it's not an option for everybody, and for those where it may be an option, you should definitely give it some consideration before jumping in, because it may be that you left a big company to be your own boss, and if you take on investors, you're going to have to accommodate them and all that. So for certain types of contracts or companies, there are other things to look at too, such as SBIR grants. I think there's been a previous seminar on that, so I'll leave that alone. SBA loans are also an option. They're fairly bureaucratic, but there's something that you can get, and you can get them. They're usually quite pretty good rate. And then, of course, the tongue-in-cheek answer on the bottom there is, if you win the lottery, so you could potentially you could try to participate in as many lotteries as possible, and you may win the jackpot.
Okay, great presentation, and we will now take some questions, which are filtering in, and we will answer those in the order that they were received. So the first one reads, we need startup funds to fulfill a purchase order. What funding options are available?
Okay, so basically, as I had said earlier, it kind of depends on what it is. If it is something that is a very custom item that a lender could really never sell, if the loan defaulted, if a loan were made to you and it defaulted and they could not sell it, then this is something that's not a good option. But without knowing precisely what this would be, the best way to get up to the point of fulfilling a purchase order is really to try to bootstrap it and to try to, you shouldn't come up with a contract where you're not going to be able to fulfill it. There are sometimes clever ways where a schedule can be tweaked, a billing schedule can be tweaked such that the minimum amount of days are necessary for, if you have two overlapping schedules, sometimes you can utilize factoring to make that happen. So it really just does depend on the type of thing that we're talking about here. But you could look at factoring, potentially you could look at asset-based lending, but it really just does depend on the company.
Okay. Next question reads, what types of government contracts are easiest to leverage?
Well, the easiest ones to leverage are going to be ones that are more than one invoice per contract. So if it is what's sort of generically called a purchase order, those are the hardest because there's just the same amount of work involved for the financial institution to get up to the point where they're secured on their contract, on their loan to you or their factoring facility to you, as it is. So for a small or a large contract, it's really the same amount of work, and so the larger the contract is, the easier it is to leverage for you because it's easier for the financial institution to do that. Furthermore, I would say ones that are for products are generally easier than services, and services are, amongst the services contracts, I'd say IT or anything where it doesn't have as much, the bigger it is with a head count, the more complicated it can be because there are Department of Labor criteria that must be met and such. But those are generally some of the easiest. One of the hardest typically is construction. There certainly are companies out there, Armcorp included, that will look at construction contracts, but there's a lot of companies that simply won't. So if it's a construction contract, that may be harder to leverage.
Great. And does it matter, or does my business have an advantage if the business structure is set up as a sole proprietor, LLC, or corporation?
I would say in general the worst type of organization from the standpoint of a financial institution is a sole proprietorship. The reason being is that you're unnecessarily intertwining everything about the person who is the sole proprietor with the business. So so anything that may not have anything to do with your government contracts or your business becomes relevant. So I would strongly encourage people to form an LLC or a corporation before seeking any sort of outside funding.
Okay. Next question is it possible to set up a factoring facility for ad hoc requirements, or do we need a multi-year commitment?
It certainly is possible. A lot of factoring companies will either insist or try to get you to make a multi-year commitment. If you're not comfortable with that, you should keep looking. If it's a fit for you, or if you're able to put a caveat in the agreement that says that you'll be with that company for that entire term so long as you have that contract, then maybe that makes sense for you. But if you really just need an ad hoc factoring facility, that's also possible. And a reason for that could be that you have, your company has a very good credit line, and that's sufficient for almost all of your contracts. But occasionally you do get some really large job that makes it so you no longer can fit it under your credit line. And so in that case, there are some factoring companies out there that will support ad hoc requirements.
Great. My company already has a small credit line, and we want to use factoring for larger orders. Is this okay, and is this a good idea?
It's certainly possible. is a lot of times it's difficult, but in terms of whether or not it's a good idea, it's a good idea if you really want to, if you've got a good credit line and you want to keep it in place, then just allow enough time for the factoring company and the lender to coordinate, because what they will need to do is sort out who has lien priority over your accounts receivable, and for the factoring company, if they're coming in after the lender, then the lender is going to already have a blanket lien, and the factoring company can't do anything, can't help you in any way until there's an agreement with the bank on that on the lien. So if you're going to do that, definitely allow enough time for all that to happen, and I would say that's going to add, potentially a month to whatever you're talking about.
Okay. Another question here reads, we are a subcontractor to a prime. They always pay us, but it's typically 45 to 65 days. What can we do to increase our working capital pool?
Well, I would say there's two quick answers to that. One, you really should look at why it's taking 45 to 60 days, because under the FAR, even if it isn't enforced very often or even understood, under the FAR and the Prompt Payment Act, the prime is supposed to pay the subcontractor, I believe it's a net 30. And so if it's taking 45 to 60 days, or if it's what they call a pay when paid clause, then that's actually not compliant with the FAR. So it would depend on what your relationship is with the FAR, and with the prime, and a lot of times a subcontractor will be too worried about upsetting their relationship with the prime to bring this up, but it is true that they're supposed to pay you as soon as the work is completed. I believe they have 30 days, and so you need to look at that. The other thing is that certainly there are factoring companies out there and asset-based lenders that will definitely provide either factoring or a lending of some sort, where you're invoicing the prime as opposed to where you're invoicing the federal government directly. So you can certainly get funding for that.
Great. Is factoring better suited for service companies, or do product companies also are product companies also able to take advantage of this?
So I'm assuming that the questioner is talking about, is this something that's available outside of the government contractor arena? And if that's the question, the answer is certainly yes. So I would say definitely. If you're a company that has an interest in factoring your AR to a company that isn't doing anything with the federal government, then there are certainly options out there. So I hope I understood the question right.
Yeah, I think so. Okay, and actually we'll make a last call here for questions. And we'll move on to the conclusions that John will wrap up with his concluding thoughts here. John, back to you.
Okay. So basically, I really can't stress enough, you can't, I know it's difficult when a contractor is out there trying to capture new business and manage contracts that they already have. It's hard to plan, but you really do need to do it. You need to, almost all of the new clients that we get are people who already have an emergency. They already have a crisis, and there's really no need for that. You should think about this problem before it happens. So obviously you need to think about it. Hopefully this webinar will help you do that. And then you of course need to prepare. And the way to prepare is to do your research, like I said in the beginning. Understand what you really need, not what you think you need initially, but what you actually really need, and then what you have to offer a financial institution. either it's collateral or it's perhaps it's personal guarantees. Maybe it's just the receivables themselves. You have to figure out what that is. And again, make sure that you are streamlined. Make sure you're not inefficient. And that's the cheapest thing you can do, definitely. And then finally, just make sure to consult and go out there and take the time to talk to a number, just like the government does when they go out and they seek a number of bidders. You should do the same thing. And when something makes sense and you think you have a fit in the price that you're hearing for the yield of the working capital, then that's probably a good solution for you.
And your last slide here.
So just to reiterate, there are, as we've discussed, there are a number of tools, and in reality, the things we discussed all have other little minor variations out there. So there's quite a number of variations of tools out there for the task. So do your research, understand your requirements, and then in the end, make sure you use the proper tool. So thank you so much, Jennifer, and for everybody else who was listening. It's been a pleasure.
Great. Great. And we've got John's contact information here. I want to thank him for sharing his time and expertise with us, and thanks for everybody who was able to dial in today. Again, the webinars are recorded. You can find them on our website under the Webinars tab, and today's webinar should be available later this evening. So just check back on our website. And any last thoughts, John?
No, that's it, but just really glad for the opportunity, and I hope people will go out there and either contact my company or another company, and so they can get the working capital that they need.
Fantastic. Thanks, everybody.